Hi, I'm Pete Andresen. I'm with Andresen and Associates Incorporated. We're money managers in Salinas. And this is my review of what happened in 2021 and what I think is likely to happen in 2022. So hang on, let's get to the PowerPoint. I'm here. Okay. This is as of January 20th, 2022. Obviously, things are unfolding already. And you're watching that. You're watching some down market action. I'm taping this on January 24th, and we saw the market drop 1,000 points and come back up 1,100 points, and I'll talk about that later. I believe that 2021 was a hinge year. It was one of those pivotal years like 1846 or 1941 when the world turns. And you may not be completely aware that it happened, except in retrospect, but I think we're going through a cycle, a phase, a time. Let's say it started with COVID in 2020, went through 2021, and we're still in it. But it's a hinge point. It's a hinge point in history where COVID, all these different forces, economic, government, global, social, are coming together to permanently change our culture and our way of life and our financial markets. And figuring that out is taking a lot of thought, at least for me. The other feature of 2021 and going back into the recent past is that we are absolutely overwhelmed with a tsunami of fake news and real news. We can't tell the difference. And we've got manias, we've got enthusiasms and beliefs. Just tune into one side or the other of the virus argument, the COVID argument, or the vaccination argument, and you'll see what I mean. So I wanted to do this. I did this quarterly report as a PowerPoint and then printed it and sent it to my clients because the graphs and the data are gigantically important, and they tend to get pushed aside by what people believe. Forget reality. What people believe becomes more important. Let me know how this works. If you have a thought on this, if you're a client, let me know. Now, if you're not a client, then this is information and it's interesting, but I'm not giving you any investment advice. I don't have a crystal ball. Nobody does. These are opinions. That's a nice way of saying educated guesses. And financial markets can go down, way down. My opinions in no way guarantee investment success. And perfection, this is big. Perfection, so far as I know, is impossible. In other words, all you got to do is be right 51% of the time. We all live in chaos, especially nowadays. I'm going to go straight to the chase. Here's what I think is going to happen going forward. And then I'm going to show you a bunch of graphs to justify why I think that way. The first thing is that inflation will probably persist at an elevated level for a year or two or three or more, but it probably won't be permanent. I'll show you why I think that. War with the Ukraine being invaded by Russia. Ukraine would be our ally, Russia would be the enemy. China attacking Taiwan, any of that, or social unrest domestically could upset my expectation about inflation. Inflation is notoriously hard to guess. In coming years, I think interest rates will increase, but they're likely to remain historically low unless something really breaks. And the reason for that is that every time they go up very far, the economy is going to come under stress, regardless of whether the Federal Reserve intervenes or not. And I predict the Federal Reserve is in a new paradigm, not the financial markets, but the Federal Reserve certainly is. They've politicized themselves and they now intervene a lot. So they're likely to intervene when interest rates start to rise too high. But let's say they lose control. Let's say interest rates spike. In that case, we'll slide into a recession and interest rates will come down. So I don't think that interest rates are likely to spike higher. In fact, I'll go one step farther. And again, interest rates they're pretty much impossible. They're famous for being something you can't predict. I would be surprised, though, if they get really high. I do expect that the bond market will go sideways, essentially, which is to say not so much in the coming decade. I anticipate higher than normal risks of war concerning Taiwan, concerning Iran, concerning even Afghanistan and Iraq, concerning terrorism, concerning Russia trying to bully its way like Germany did in 1939. I expect more political unrest as fake news and media mania causes more extreme belief systems to emerge within the United States. I think that the stock markets are overvalued, although I think that lower interest rates have kind of warped our traditional valuation process. I do think they'll decline at some point in the coming decade, but not necessarily in 2022. The little kerfluffle we've seen so far in January could be corrected in a blink if somebody in the Fed gets up and wiggles their finger. We are Fedicted. That is, we are addicted to the Fed right now. So the stock market may not decline in 2022. But if it does, the decline may erase stock market gains going back as far as 2015 or 16. In other words, there's a potential that this could be big on the downside. Our diversified portfolios, because here at Andreessen Associates, we're famous or infamous for our diversification, should decline much less. During a stock market decline, nobody will know what's going on, especially if it's happening because of a war. Fear will dominate the media. There'll be much shrieking, gnashing of teeth, and we'll buy. We'll buy equity mutual funds incrementally, beginning with about a 10% decline. Now you're saying, okay, the NASDAQ is down 14% from the high. Why aren't you buying? And that is because we're not really down in a substantial way yet. The people are not going to really make this market go down until they become convinced that the Federal Reserve will not intervene. When that hysteria seizes the market, that's when we'll see a change. For example, why did the stock market drop 1,000 points and then come 1,100 points back up? Because of the investors' perception that the Fed will intervene soon. That's their perception, that the Federal Reserve will walk back its plans to raise interest rates mildly in 2022. That's it, prediction. We will probably buy international small cap and value funds mostly, but if the decline is big enough, we'll also buy tech. Technology is the future. Mostly we're going to chase bargains wherever we find them. The other thing is that the stock market decline bottom and the initial recovery will be apparent only in hindsight. If it's 10% down, the decline may have already ended today. If it's, in which case it ain't worth chasing. And our intelligent portfolio system already picked up a couple of small buys. Our purchase will set us up to possibly outperform the Vanguard numbers that you'll see later. That's the goal. The goal is to outperform those Vanguard numbers, and we've done this in the past. We did it in the 1990s. If you've been around for a while, we did it in the 2000s. And we can do this again, my opinion. In the long term, my goal, and this is a guess, okay, is that we'll be able to at least double our current holdings in the coming decade. I can't assure it, but that's the plan. So let's take a look here. Let's continue. If you were in small caps, the market was good, but if you were in large cap growth equities, a select dominant number of those in the S&P 500, 2021 was an awesome year. 70 record highs for the S&P 500, which has not been equal since 1995. Hey, what happened after 1995? the crash of 2000. But anyway, the S&P 500 closed at a record almost 30% of the time in 2021, which resulted in the creation of $8.6 trillion of new money. So we have been blessed. However, it was also a slightly negative year for bonds as interest rates began to rise slightly. Old economy energy stocks and a couple of those mega caps just rocked. But the more speculative stocks cracked, like in 1999. So if you look at this thing, what I realized that my what do you call these things? My subtitles or whatever are kind of washing out my graph, but bear with me. I mean, we'll get there. Bottom line is that the S&P 500 up 28%, small cap up 14, international up 12, health sciences up 11. So you can see it's not all wonderful. Innovation negative 23. That's Kathy Wood's ARC ETF, down 50% from where it was, the high, as is the stock Netflix, and we'll get into that a little bit. We had some wonderful sectors: big tech, semiconductor, oil and gas exploration and production. Hey, how about that global warming? REITs and asset management. If you're into stock market management companies, they did well too. The big news is that the S&P 500 is dominated via computer by a few giant stocks. I mean, I think 20% not so much, but if you were in Apple or Google, you just shut out the lights. Tesla up basically 50%. But if you were over on the other side of this thing, like Verizon, not so much. You could actually lose, it's quite possible to lose money in 2021. I'll tell you another thing really briefly. I hold and manage a couple of individual stocks, and we put stops under them. That's a protection. That means that when the price of the stock comes down via market action, it'll automatically sell. And that I put them usually about 20% under the high. Well, these stops blew out and the stock kept falling. So there was a surprisingly large number of stocks which went down in 2021, which again is just like the 90s. Precious metal miners, Chinese e-commerce got clobbered because of political action. Solar companies. So let me get this straight. Solar companies, Sunrun lost 51%, and I could make 50% in some of the oil stocks. Are we going green or what? Looks to me like the same people who are voting for Bitcoin are also voting for oil and gas. What a concept. Inflation in 2021 was higher than during any of the past 40 years in 2021. But that doesn't mean much because in the last 40 years, inflation has been really, really abnormally low. We are being wrapped around the axle by a bunch of media people that are putting out conflicting numbers of inflation, but they're missing the point. The point is that by whatever measure you take, we've had really, really low inflation for 40 years, and now it's back up. High inflation is always a regime changer. It creates social unrest. It creates geopolitical turmoil. In the long run, it's pernicious. It's a wealth-destroying monster. Even if it's only at 2%, even if it's low, eventually it corrodes like a termite or a Torito shipworm through your financial ship. But we can cope with it historically by remaining at least partially invested in equities, because bonds barely outperform inflation over the long run. Stocks do outperform inflation over the long run. But to do that, you have to have the courage to have the down markets. So we got to detach ourselves from the year-to-year behavior and focus on where do we want to be in 10 years, because that's where the money gets made. 10 years, 20 years. People say, I don't have 10 or 20 years to live. And I say back to you, your heirs do. So if you're really trying to create lasting wealth, everybody hearing this has 10 or 20 years. The other thing is that the demand and shortages which drive inflation historically always lead to gluts. We saw an example on January 24th, that would be today, where Netflix, remember Netflix went soaring. I think the stock hit about 700. I think it was in November of 2021, and then turn around and reach for the pavement because the market got saturated for streaming. All the people who in the pandemic moved to Netflix, cut the cord, went to Netflix, seeking the cocoon of a sequestered life. They're now branching out into other directions, and they're also thinking about post-COVID. So Netflix, which I think is a marvelous company and worth looking at now, is down 50% from its high because of a glut of streaming services. It's a glut. Same thing happened to rubber gloves. Same thing is going to happen. Okay, it's January 24th, 2021, and I make a bet. Sometime in the next 5 years, there will be a glut in cars. Let's watch. Thus, in the long run, I do not expect high inflation to persist for an entire decade, although it might even get worse in the short run. Media people are provoking all kinds of anxiety and uncertainty and shrieking mania. The statistics are less relevant than the fact that, yes, we have inflation. Yes, we already know how to beat it. And no, it is not likely to persist because we will change the entire government if it does. Look to your history. Look to the 70s, look to the 80s. History tells us that inflation is cyclical. Thanks to the Federal Reserve, interest rates in 2021 stayed artificially low. The bond market now is a hockey puck for government, which is very sad because without Federal Reserve intervention, just the natural bond market, I think investors would have figured it out better than the Fed did, and I don't think we'd be dealing with this inflation. With inflation increasing, many bond market sectors were mildly negative for the year. U.S. corporate bonds were negative 1.12%. U.S. core bonds, that's corporates plus treasuries plus mortgages, were down negative 1.61%. High yield bonds, which act like stocks, we're talking junk here, lifted up by the Federal Reserve intervention in the junk bond market. Now, let me get this straight. What are junk bonds? Junk bonds are bonds that, unless the company grows, can't pay the money back. That's why the credit rating sucks. Right. Is that where you want your money? Anyway, it was up 5.24%. The dollar, and this is big, interest rates are artificially low, suppressed by the Federal Reserve and the government's intervention. However, it's worse overseas. Japanese, European, a lot of the bond markets over there are actually negative interest rates. You actually pay to buy a bond, which is, I think, philosophically so bizarre that in 30 years, people are going to be telling stories about the insanity of investors in the early 21st century, the insanity of our behavior. Think about it. If an interest rate is a real reflection of the economy, then what are the Europeans and Japanese saying about their expectations for their economy going forward? They're saying it's going to contract, aren't they? Otherwise, you'd factor in a growth rate, and that's not there. Anyway, government suppression had its role to play in 2021. Interest rates stayed artificially low, but they stayed higher in the United States, slightly. Thus, the dollar went up versus most other currencies. It also was a refuge, a safe harbor in a world filled with fear about what's going to happen politically in China, in Taiwan, in Ukraine, in Russia, all over the world. Now, what that does is that means that our investments in our international funds denominated in other currencies actually didn't have a chance to show us what they can really make because the value of that currency went down. Vanguard is now predicting that the average annual return in the S&P 500 will be lower in the coming decade than they were in the past decade. They've been wrong for the past 5 years or so. This implies a temporary downturn. The reason they've been wrong, they actually did a study, and I'm going to cover that in a video in a couple of weeks. They actually did a study and they figured out that it was investor mania, tulip bulb mania, that's driving this engine because of, let's say it again, addiction. They are addicted to the Federal Reserve. Investors think that there is no risk as long as the Federal Reserve will always support the stock market. The only problem is the Federal Reserve is going to run out of money and print our M1 to a place where we have to cope with permanent inflation, which will lead to regime change. So, in other words, at some point, this thing's going to break. Many stock market valuation models are suggesting that the S&P 500 is more overvalued than at any other time in its history, except for perhaps 2000. The S&P 500, however, is not the entire stock market. The stock market is filled with relatively mildly valued and even undervalued investments that I'm planning on picking up. I just want to get through the coming turbulent year to do that. But if you look at this thing, this is equity market capitalization to nominal GDP, and it is, in a word, absurd. The Federal Reserve and governments have added profoundly and unnaturally to the money supply to cope with the 2008 financial panic and now the COVID pandemic. Okay, it started with the millennium. It started with the Federal Reserve. It started in the Bush administration when the Federal Reserve flooded the banking system to prevent what they thought was the Y2K bug from coming out. Y2K didn't happen, but 9/11 did. And since then, there's been some sort of Federal Reserve intervention. I've mentioned in past videos that we're all participants, willingly or unwillingly, in a giant governmental experiment of intervening in capitalism. This has caused debt formation to soar. I misspelled that. I said foresoar. I meant to soar. Now, I'll cover that in a coming video, but the bottom line here is that with low interest rates, corporations were rational and they went out and created all kinds of debt. So there's debt out there like we've never seen before. Asset bubbles have formed in the stock, bond, real estate, and the crypto markets. Unless you can teach something to me that I haven't found yet, I think that the crypto markets are basically a tulip bulb phenomenon. I could be wrong. I think blockchain has something to do with it. I mean, that might actually be a usable technology. But remember that all emerging technologies take years to find fruition. And crypto right now is, to me, a Ponzi scheme. Now, I could be wrong. I'll be happy if you come to me and tell me I'm wrong. But right now, it doesn't seem that attractive to me. Inflation is causing the Federal Reserve to consider reducing money supply and debt formation gently. Now, the underlying words are really important, and that is that my belief is that the stock market and the bond market and the real estate market and the crypto markets long-term will go up until the addiction is broken. That means until investors become convinced that the Federal Reserve will not save them from down markets and will reapply its energies towards inflation. Once they perceive that the Federal Reserve is just going to watch this thing unfold, which is actually what they're supposed to do. They're not supposed to intervene every time the market goes down, because a down market weeds the garden. A down market weeds the weak herd members out of the stock market, just like wolves benefit an elk or a moose population. The Federal Reserve has created an extremely overvalued market. It's going to stay that way until investors believe that the Federal Reserve won't save them just for the sake of saving them. Now, there'll be fear, loathing, shrieking, wailing when that happens, but it's natural as rain, so don't freak out. They may continue, all these markets may continue in their bubble in 2022, but at some point there will be a return to fundamentally based valuations, or we're in a new paradigm. I don't think we are, but I do think that our valuation measures, let's go back, are somewhat skewed by the low interest rates that we're likely to experience. In other words, I would be surprised if this thing went all the way back down to fair value, because the lower interest rates really do create a situation where it's going to be more attractive to invest in stocks, if only for dividends. So for that reason, I can't be confident that this thing is going to go all the way back to a reasonable valuation, but it should go part of the way back. Now look at this graph over here. It's a little shrunk, but that's the money supply. That if I did that in a finance class in a university back before the days of intervention, they would have flunked my butt so fast, and they would have laughed as they threw me out. So, asset class returns. Okay, my subtitles are getting in the way here, but bottom line is U.S. inflation 1.4 to 2.4% over the next decade, hardly earth-shattering. So inflation should moderate. But check this out. We've been making about 15% a year for the past decade. That's just bizarre. I mean, I'm happy. I'm a lot wealthier because of it. But check out U.S. equities. They're expecting 4.3%, value 4.9. Come down here, and global equities without the U.S. are at 7.1 because international isn't as highly valued. So they're coming at this from a valuation point of view. Bond market is basically going to lay there. Best you can do is 2.3, 2.9 if you go into junk. So it's going to be a low return decade if they're right. And like I said, they've been wrong. Excuse me, wash my mouth out with water. They've been wrong for the past 5 years because they very much underestimated two things. Number one, the Federal Reserve stimulating. Number two, investor mania that we're still experiencing. So why don't we just go to cash? I mean, Pete, you're a genius. You should do this. And like the movie, what was that movie called? Where the Marine colonel yells, "You want the truth? You can't handle the truth." The truth is that cash is dreadful as a long-term investment. And as with Vanguard, forecasts of doom have been wrong in the short term since the Fed has continued to intervene. And they're going to be, forecasts of doom will continue to be wrong until inflation tips us over or the Federal Reserve signals that it is going to fight inflation. So will the markets decline in 2022? I cannot say. But if they don't, the markets may decline anyway, just based on inflation. Most investors can't handle the emotional consequences of sitting in cash while markets rise. I get told routinely when a client calls me and says, "Get into cash, get into cash," I will get a phone call 6 months later or a year later. Why did you do that to me? Not why did I make you do it, but why did you do that to me? And then the other problem I have is that that person who goes into cash will not have the capacity to pick a bottom because nobody can pick a bottom. Bottoms are only recognizable in hindsight. So holding cash does not add value. So you sell out, you're in cash, great. Now you can't buy back in because you're afraid of it. The market comes all the way back up to where you sold out and keeps going 50% later. Market's 50% that way, and you call me back and say, well, it's time to get back in, which is actually a sign that the market's overvalued. Actually, I had a client who recently passed away from COVID, and he was a human metronome in the sense that he could pick market bottoms and he could pick market tops in reverse better than I could. What he used to do was he'd call up right at the market bottom, although, like I said, recognizable only in hindsight. And that would be about when he broke, when the fear finally got to him. He'd say, get me out, get me into cash. I insist. Pound the table, pound, pound, pound. Get me into cash. So we'd get into cash at the bottom, and the market the next day would go up. Market would continue to rise. He wouldn't be able to leave cash. We'd get to the top and he'd say, oh, it's time to get back in. Why did you do that to me? Why did you make me go to cash? Get me back in. So we get back in, and the next day the market drops. That's what happens when you go to cash. The world is replete with very intelligent investors who made big decisions to get safe and temporarily lagged as a result, and the clients beat the stuffing out of them. These are the 2-star funds, 2 stars out of 5 stars on Morningstar, that those of you who watch Morningstar will call me up and you say, why are you in that dog? Why are you in that dog? Well, because that dog was not a dog over the long run. I mean, they've been really, really good at picking markets. They've been really, really good at picking valuation. No, they're a 2-star fund. Why aren't we in 5 stars? So here we go. Forrester Value Funds, one of the most intelligent groups I know. Huffman Funds, again. Intrepid Funds, and hidden under there, hidden under my my subtitles, is Centerstone Funds. We're actually going to talk to the manager of Centerstone Funds, who is, again, looking at this just like I'm looking at it and saying, hey, does valuation matter anymore? So join us. You want to do this whole thing live, January 27th, 2022. That's this year. 12 noon, you grab yourself a sandwich and sit down and watch us. We're going to have a Google Meets. My son, Eric, has joined our business, and he's going like a house fire, changing this all over technologically, which is good because it needs to happen. Boy, and he will be dragging us into a Google Meets. He'll be coordinating it. And I will discuss the investment markets, and he'll run the whole program. Call us up to reserve a space. But then on February 9th, 2022 at 1 p.m. Pacific Standard Time, join Abhay Deshpande, one of the most intellectually competent investors I know, who struggled during this time of overvaluation. And we're going to discuss, does valuation matter? So if you're wondering if we're in a new financial paradigm, I am, you'll want to attend this. So call us at 831-758-1575 and reserve a space. Okay, Happy New Year. My next video is going to be about the year of the Asian New Year, and what do we have to look forward to with 60-40 portfolios once we get through these other 2. So I look forward to seeing you, and Happy New Year. Thank you.